The single biggest thing that makes me really worried for gold now, like in Delhi and all, HNIs were buying kilos of gold when the panic set in, right?
There are better things to do in life than worry about whether it's 25% or 26%, like shit posting on
Don't
Twitter.
make a second career out of your portfolio.
Exactly. If you take gold price from, let's say, roughly 2012 to there about 2019, gold did nothing. It was literally flat.
So we'll explain what is gold price, what are the components in it, how much is import duty, how much is some other duty. Then we'll talk about historical trends of gold. And in fact, we'll even answer the question, should you invest in gold? And finally, we'll talk about...
As a self-respecting Mallu, I just have one question for you. Have you ever smuggled Dubai gold?
I can't hear you.
And how? Okay, I'll set the context. The context of just a brief refresher, rupee is down about roughly 10-11% in the last 1 year. So we spoke about that, what you can do, how does it hurt you, why is this happening? And towards the end of the episode, we got to a brief discussion about gold, and I said gold doesn't hedge inflation. And you suggested we do an episode about gold.
Yep.
And that's what we'll do.
Yeah. But we'll just say the agenda so that people know what we'll talk about before they decide to waste like 45 precious minutes of their life on this thing, right? Now.
But did you smuggle gold? It's okay. You can. It's a safe space.
So first of all, most people don't understand what is this gold price, right? Like I know for a fact that even when I was trading or looking to trade gold, I didn't exactly know, for example, is GST included in MCX gold price or not, right?
By the way, there's a duty called BCD.
Oh, so we'll talk about BCD also. So we'll explain what is gold price, what are the components in it, how much is import duty, how much is some other duty. When you trade, when you do physical, what are the things involved? When you trade exchange, what are the things involved, etc. Then we'll talk about historical trends of gold to explain what gold has done over the last 100 years or so. Then we'll talk about why should you invest in gold. And in fact, we'll even answer the question, should you invest in gold, right? And the Bhuvan will, of course, answer the bombshell which he dropped last time, which says, does gold act as an inflation hedge? And finally, we'll talk about the best and worst way to invest in gold.
Yeah, all the options.
That is our agenda.
Yeah.
Right? So then where do we get started? We'll probably...
At least to me, this is one of the most annoying asset classes. It's because you ask two people, nobody will say the same thing about gold. Like we got to the discussion about inflation. It's a very emotional asset class for a variety of reasons, especially for Indians.
Yeah.
The white people don't really care that much about gold, but it's a deep part of our cultural fabric. Yeah. In fact, it has done more for the average Indian household than pretty much any other asset class. Yeah. Which means...
But that's because of currency depreciating and not because of gold appreciating.
Doesn't matter, sir. Indian housewives win.
Yeah.
It's India's favorite asset class. In fact, it's like the affinity for gold is almost genetic. I think it passes on from generation to generation. It's the oldest asset class apart from land that we have. But even now, I don't think anybody can clearly say what is the case for investing in gold. Yeah. That's partly because it's a dumb rock. It's literally a dumb rock. Like there's this journalist called Jason Zweig. He called it a pet rock. I think Keynes called it a barbarous relic. Fancy stuff. And even when I was trying to understand, I still don't really have a good sense of, like what's the case for gold. You ask any reasonably informed person in the investment management industry, they'll give 25 different reasons. And every single reason has some truth to it. But the more you dig into it, I think it becomes very clear why, it's not that complicated, but it takes a while for you to go through that fog of nonsense before you get to it. Apparently, you can trace the history back to Babylon, it seems. There was one king and one fun anecdote. The Roman centurion was getting paid some 8 ounces of gold or something like that. The same, if you adjust it fast forward today, the average US soldier gets paid the same amount of money.
What?
Yeah. So it has held purchasing power.
Okay, that is crazy. Yeah. I didn't know this.
I forget the number, we'll put it in the show notes. I found this interesting paper. So it has held its purchasing power for roughly 2,500 years.
Yes. And even Ray Dalio's book was talking about how the only asset class with any real return over like 1,000 years or 300, 400, 500, 600 years is gold.
So this is battle tested.
If you want to keep generational wealth, in case you have it. Right.
Not in the USD.
Where do you keep your generational wealth, Bhuvan?
Yeah.
But anyway, so we'll just explain to people what is this gold price.
Yeah.
Right. So I'll start with the most basic thing. What happens when you buy gold from a jeweler? So obviously there is price of
Okay, where does, I mean, people also don't know that we don't really produce any of our gold. All our gold is imported.
All our gold
Literally all of our gold. Yeah.
Used to, but British people took all of that.
Let's not, can't blame white people for everything, sir.
So when you buy gold from a jeweler, there's of course the price of the metal. Then there is making charge. So if you're buying jewelry and all, the making charge can be as high as 20-25%. But we won't talk about that because that's not an investment. That's just like an emotional purchase, But normally we'll just keep our making charges to bars, coins, etc. So even that is like 5% on an average. So 5% of the price you're paying for gold is actually the making charge for a bar. I don't know what kind of making charges are there for a bar.
Make it into a bar.
Make it into a bar, what making charges? But if you go to a local place, you can even get for local bulk guys, even give it for as low as 0.5%, right? So you need to keep this making charge very low so that maximum amount of money goes into actual price of the metal.
Yeah.
And now comes government with GST of 3% on all physical gold, right? And there's also a tiny 50 rupees hallmarking charge because BIS puts a hallmark saying, okay, this is 916 and, So basically gold prices, gold prices, price of the metal plus making charge plus GST. And GST on making charge is 5%, GST on metal is 3%, but roughly 3 to 5%, whatever you can, right? But this is where things get interesting. So because this everyone understands. The question is, what is this price of the metal? Because like Bhuvan pointed out earlier, gold is not mined in India and everything is imported, right?
Yeah.
So first you have to start with a global market price. So when people say, normally when you ask a person where is gold trading at, they'll say $4,500, bro. They're like, $4,500, what for what? So it's normally $4,500 for a troy ounce. It's a unit of weight of gold. And this is usually the price which you see from COMEX in US. It's a commodity exchange in UX. And if you're looking at physical price of gold, it's almost always the price of gold in London, right? London is the physical trading hub apparently. London is a much more important financial market than most people say it is, but that's a very different story. We'll come to that. So probably we should do
Not anymore, but yes.
We should do an episode on City of London though, not the London, City of London. It's like another thing altogether. So now you have troy ounce, right? Now you have to convert it into grams. If you want to bring it in India. So then basically once you want to bring it in India, you have to convert troy ounce to gram. Then you have to add the exchange rate. So whatever that US number is, you have to do into 95, 97, whatever it is. But here is things get even more interesting. There is import duty and all import duties plus taxes put together is roughly 15%. So 9% or something is the import duty, 10% is import duty, 50%, 5% is some Krishi something, agricultural cess or something it's called. It doesn't matter what name.
Make farmers great again.
But it is duty, right? And then there's a small handling margin because you're importing gold, etc., etc. So, and of course, finally, there's local supply and demand, seasonality, is there weddings happening, etc., etc. So, if we do the math on screen, it will be troy ounce. We have to convert to gram. Then we have to do the exchange rate. Then we do 1.15 multiplier for duty. Then it will roughly match MCX gold price. Interesting thing, GST is not coming yet because GST is only there for physical gold. We are still talking about traded commodity gold.
Yeah.
Now, roughly it should match your MCX price, but of course there's an interesting thing. This is a 24 karat gold price. Normally the gold which we talk about, at least in jewelry context,
22
is 22 karat, right? But here's the key takeaway. 15% of gold price is just duty, right?
Pretty cheap. It's pretty cheap, sir.
Which also means if government decides to remove duty, 6% will go. I mean, recently they increased it around 6% more. So if they roll it back, 6% goes just like that. And this is one reason why a lot of people, especially from my home state, like he was mentioning earlier.
You still didn't answer whether and how.
So gold is so much more cheaper in Dubai because there's hardly any duty or anything there, and it's a global trading hub again. So people go and buy gold in Dubai. Every time people go tourism in Dubai,
Nobody goes there for tourism.
there's a legal limit for men and women, some X number of grams. People buy it because it's cheaper in Dubai, right? Which is also one Dubai versus normal India arbitrage. But anyway, the big point is that this is how gold price comes in, right? You take the international price, convert it in local grams, make it 22 carat.
And then add a nation building tax.
Yeah, and add. But now I'll give it to Bhuvan because we have to talk about the historical price charts.
Okay, so forget the 1970s history. I think the thing to remember at least is if you take gold price from let's say roughly 2012 to there about 2019, gold did nothing. It was literally flat.
2012 to 2019 in terms of US or INR?
INR doesn't really matter. Set aside INR. For gold, all intents and purposes, INR, you'll anyways make your INR return no matter what because rupee depreciates. For all the reasons we spoke about.
Dude, you live in Bommanehalli, right? Not California.
It's priced in dollars.
Okay.
There's no rupee gold price at all.
Fine. So
that's utterly irrelevant.
2012 to 2019, gold did nothing.
More or less.
Actually, yeah. Yeah, we can bring that. Actually, yeah. In around 2012, gold was priced at around 2000 and in 2020, it was back at 2000. Till then, it was dipping. Yeah.
Nothing. So, the reason why I point this out, the reason why I'm starting at this level is because right now equity markets seem to be, since 2024, September roughly, we have been in a sideways market. Historically, there hasn't been, if you remove that dot-com phase for equities, there hasn't been any single period where equities did nothing for more than
even in INR terms, it returned nothing, 2012 to 2019.
Oh, this I didn't know.
Yeah.
But I think slightly 1 or 2% you would have made.
Yeah, but that's hardly anything. But I'm looking at gold XAU INRG on TradingView.
That's decent.
It is nothing.
Yeah.
Basically, gold was around 3,000 rupees per gram in 2012 July. And in 2019 April, it is still 3,000 rupees per gram.
And a lot of weird things are also happening in that moment geopolitically, but we'll get to that later.
2012 to 2019, real estate return in Bangalore was also zero. People don't talk about it, but real estate return was
that was
zero.
the lost decade for real estate, pretty much.
Yeah.
If you do real returns, it gets even worse.
Okay. So, but interesting. So maybe there is some relationship between all three, USD gold, INR gold, real estate, but beyond our pay grade.
But anyways,
back to you.
Gold did nothing. The reason I'm important because Indian equity investors have never gotten used to a decent bear market. 2008, there were like 3 investors in India. COVID was like for 4 days, even though we were all supposed to die. So it's literally been like a one-way ride above. I always use this gold example to point out that there can literally be almost a decade-long period where an asset class can do nothing.
Yeah.
If you look at the US history, this becomes even more stark.
Yeah.
So gold did nothing. And in 2020, because of COVID shock, it rose first, then it fell, and it did nothing again until 2022.
In USD terms, yeah.
Yeah, roughly.
Yeah.
And then since 2022, it's just been one-way ride. Roughly, I think on the eve of COVID, we're at whatever, I think 3,000 or 4,000 rupees a gram.
Oh yeah, actually, yeah. 2020 to 2024, nothing.
Yeah. So then it's just been like, it's one of the greatest rallies for any asset class that we have seen, at least in the Indian history, for a very long time.
Or the greatest pump.
I don't know.
Okay.
But there is some data to show that it's not a pump in the traditional sense, but financialization. But we'll get to that later. So today we're at roughly what, 15,000, 16,000 rupees gram thereabouts. It's crazy because financial gold, when I say financial gold, things like let's say SGBs, which are no longer available, ETFs, etc. Typically jewelry demand and gold prices tend to be inversely correlated. Partly because gold becomes costlier, people can't afford to buy jewelry. So, but investment demand and gold prices are almost always positively correlated because people chase returns. And even in our own data, it shows up. Fun fact, I think 1 or 2 months ago, don't hold me to, like roughly 2 months ago, gold flows, ETF flows, mutual fund flows was higher than all the equity mutual funds put together in India.
Isn't that the sign of a pump?
It depends on how you see.
Because the largest retail participation.
But pump implies there is one actor with an agenda to pump. Like, I don't know who's pumping gold prices. Maybe Putin, but I don't know.
Like if you look at it, the highest retail participation in equities in India was also in 2024, 2025 types, right? And that is the all-time high.
Yes.
Like the single biggest thing that makes me really worried for gold now is the fact that all these people have, like in Delhi and all, HNIs were buying kilos of gold when the panic set in, right? And they are down 20%.
But this time is a little different, partly because one, of course, I mean, anything prior to 2000, the prices are irrelevant. It's mostly US history. It doesn't really matter to us much. The reason why I say that also is because financialization of gold only started in the early 2000s. When I say financialization, the first leg of so when I say financialization, gold became tradable only in the early 2000s. Gold futures are not really that old, at least in the Indian context. The first ETF in the US was roughly 2004. In the India, it was gold base was 2007. So the reason why I'm starting not from 1970s, the gold window, Bretton Woods and all that collapses, because I don't think, although it makes for nice, interesting history for a lot of people, although you can go back in history and say until 1960s, we were all in a gold standard, everybody, the entire global economy used to run on gold prices, and then in 1960, Richard Nixon closed the gold window and all that. While it's interesting history, I don't think it's immediately relevant for a lot of people, at least the younger investors.
But because I'm the tinfoil conspiracy theorist,
nothing really happened. There's no Rothschild, no gold, nothing, none of that.
I'm not saying that, right? I'm only pointing out something which might be interesting, because see, stocks, we can't really talk about what was the interesting history of Infosys stock in 1980 because the stock probably didn't exist. But with gold, you can talk about a lot of stuff, right? So I'm going to say something.
Okay.
July 1976.
Okay.
Gold price was at around 103.
Right.
October 19, or rather, this is Jan 1980, 4 years later roughly, 3 years later roughly, gold hit 850. So you have to look at the numbers, 100 to 800.
This was the greatest, the mother of all inflation shocks also.
Could be, right? Oil shock, Paul Volcker did that, interest rates were...
He took it to 19%, but yeah.
And after that, and now people say, okay, you know what, uske baad interest rates were raised and gold fell. But after 1980, gold fell to 300 by 1982 from 800.
Ouch.
Right?
Ouch.
And then it stayed. So to recover to 800, oh God, wait. Sorry, I'm taking so much time because I'm still scrolling to see an 800 number.
You're scrolling decades.
The 800 number was reclaimed by gold in 2008.
Holy.
Right? So for 30 years, gold did nothing. So for all the gyan which we talk about, gold always...
Long term, everything goes up.
In USD terms, it did nothing. So even if you are an SIP investor of gold, probably you would have hardly returned anything.
Yeah, 3-4%.
Maybe you would have even been...
break even maybe at best.
You would have been slightly better off because the fall was rapid, the climb was gradual. But so this is one, right? 1982. In fact, the fun fact is, this is gold USD I'm talking about. Gold INR.
We don't have a long history.
No, we interestingly, TradingView does that because...
I mean, that data I'm not really sure about. That's the other problem with gold is because no two people are referring to the same price.
No, but they can talk about XAU, INRG, just converted. Just INR conversion. Forget local duties, demand, Shadi season, everything. So in 1980, same period, gold was 38 rupees in around 90 for a gram, right? It was 39 rupees for a gram in 1977. 210 in 1980, right? 7x, right? In fact, it...
pretty good.
really good. Right? Then it was reclaimed in Indian INR terms in 1989, a decade, because rupee depreciated, right? Because
and that was a horrible period for the rupee, I think.
Yeah, very horrible.
Yeah.
Now comes the interesting part. Even in mid-90s, gold hit 500 in INR terms, went to 350, reclaimed in mid-2000s, right? 10 years of nothing.
Yeah.
Where gold really held value in INR terms is 2008, it was at 1,000, and then it reclaimed it in 2008 after the crash. Like 2006, it was 1,000, and 2008, 2 years later, it reclaimed. After that, gold has just been one-way street in INR terms.
Yes.
And then, interestingly, in 2012, gold hit a peak of 3,000 per gram. And like you said earlier, in 2019, it did not do anything. Clearly, gold always goes up and always like...
It's as volatile as equities.
But here's the interesting part. The kind of astonishing movement that you saw in gold, which you're seeing now, the 1980s rise of gold looks pretty similar.
I mean, this is a chart crime, but somebody had done it if I remember correctly. They'd overlaid the 1980s, 70s ka price, thing on this thing. The shape looks similar, but it's a chart crime.
It's a chart crime, but we'll see. We'll find out.
It's a dumb way of looking at.
So the trend.
If somebody says, okay, why are gold prices going up? Like going back to our USD price, is because somebody is buying more than selling.
And in India, gold price goes up mostly because currency is depreciating. Because like we said earlier.
Yeah. Like even if gold price stays constant, let's assume that a gram of gold is 100 rupees. Yep. It's not, but 100 rupees. Yep. If rupee depreciates 4%, you make 4% return, regardless of what
That's
happens.
it.
Yeah, it's
not 100 rupees. It stays at $100.
Yeah, sorry, $100. $100. So you make the rupee depreciation. That's a guaranteed return.
Yeah. So then, what's your advice for our Janta?
See, I think you still need to understand what's happening with gold to get a sense. Like, for example, the reason why I said history prior to 2000 is irrelevant because it was very hard to buy gold. I think from 1930 to 1970, buying gold in US was illegal. The fine was $10,000 and lifetime imprisonment. And that $10,000 in today's price apparently was $250,000 fine.
Whoa, okay.
So FDR had made it illegal.
Okay.
And you also, until 1960, gold was more or less pegged at whatever that, some $35 an ounce or whatever it was. So that looking at that historical price chart before 1970s, it becomes a little problematic because gold price was fixed.
Abhi kya kare, like?
1970s roughly is the start, and more importantly 2000s because you had futures on gold. So that was the first leg of demand for gold. You had ETFs in the US. By the way, fun fact, I think after 3 days of launch of the first gold ETF, it did $1 billion, it seems. That was the demand for gold even as far back as that in the US.
All of this is making me feel like a pump. So, but then, yeah, okay. So are you telling people should invest in gold or not?
I'll say the facts, like people have to make their minds. The reason why I'm saying it is because that was the first time when there was like a structural bid under gold. So you have ETF investment flows from gold. You also have for the, roughly from 1990s until 2008, central banks were net sellers of gold. Starting from exactly in 2008, central banks became the dominant buyers of gold. It starts with roughly whatever, 100 tons. I think the last data I have, they bought 1,000 tons of gold.
Oh, okay.
They were the single largest dominant buyers of gold. So
what do? They buy it and then put it in ships, and is it like a way?
It was in London, now it has been nationalized.
Okay.
So
can we like
1,000 tons?
Know where that ship is like?
I don't know about the conspiracy theories and all that. Like, I don't want to get into the tinfoil shit. The reason why I said all of this is because gold ultimately has no real yield. Like you buy a bond, you get a coupon.
This is the problem. I feel very uncomfortable sitting on something that is not yielding anything.
The reason why I'm getting into the history, because if there is no yield, if you don't know what are the drivers of demand, then you don't really know who's doing the pump.
Yeah.
So for the longest of time before gold became financialized, the only real pump was jewelry buyers.
Yeah.
There was no, because gold has no industrial use, more or less. I think the industrial use is roughly 6 or 7%, which is negligible. Gold also is more like Bitcoin in a lot of ways, that there is fixed supply. I think the annual...
And it's valuable because people consider it valuable.
Exactly. It's a greater fool theory. Why do people like gold?
Isn't dollar...
But they have guns. And also 50,000 nuclear bombs. So the counterintuitive fact that there is always demand for gold, which means it tends to fall less than it goes up. Like that is very important to understand. So today, most of the gold demand is coming from investment flows. Ironically, again, don't hold me to the numbers. Like for those 3 or 4 years from 2020 to 2026, US investment flows were negative.
To gold.
Yeah, ETFs and funds were net sellers of gold, but gold prices continued going up. But in India, it was the exact opposite. So depending on which country you look, also gold, the structural factors change.
So no answer. You won't say ki always invest in gold as a true.
I don't know. It's like if you look at the math, anywhere between 10 to 20% of your portfolio allocation, gold enhances your portfolio risk. In fact, fun fact, roughly from 2005 to 2026, if you swap out bonds for gold in a 60-40 portfolio, a 60-40 portfolio roughly would have done, let's say, 13%, with, I think, close to 40% of drawdowns, which means from your highest portfolio value to the lowest, the drawdown was 35, thereabouts. If you remove bonds, just add gold, you get 16% returns and your drawdown reduces by 2%.
So it's a better portfolio.
That's because of the recent rally. So this is the problem with data. The reason why I'm not saying always buy gold is because we only have one roll of the dice. In fact, the oldest gold fund is barely about 20 years.
So if you were unfortunate enough to put money in gold in 2012, you lost a decade
And also during the period which you said, from the 1970s to 2000,
Yeah, 80s.
you did nothing.
Yeah.
That's, for most people, the other problem with all of this is people say long term. Let's assume 20 years is long term.
20 years, yeah, long term. Boss, like by 20 years, I'm like past my prime of life. What will I do with the gold?
That's the first problem. And by the time you start saving, you're already in your 30s.
Yeah, but then probably generational wealth argument, yeah.
That is long term.
Yeah. So then why should people invest in gold at least?
The typical argument people say is gold is an inflation hedge.
Yeah.
It's nonsense.
Currency debasement? In
That is-
Indian context?
That is a better argument. Like, that doesn't apply to the US people because it's the dollar, even dollar debases, everything is priced in dollar, there's no debasement, theoretically speaking. But for an Indian guy, currency debasement is a much better this thing.
But I mean, if you're arguing with that, you can even argue any metal, because if there's more of currency, any commodity becomes more expensive.
Not really, but other commodities tend to be volatile. Like,
Gold is less volatile than other.
Replace gold with silver.
Enough. So currency debasement?
And second thing is, there is, like, I want to qualify the statement when I say it's not an inflation hedge. So if you do, let's say, month on month gold versus CPI correlation, it's almost zero. US CPI, Indian CPI, there's almost no correlation. 1 or 2 years, again, no correlation.
Okay.
The correlation only starts roughly from, let's say, 5 to 10 years. So then you're looking at 0.5 to 0.10.
So you're basically saying inflation
over long periods.
Okay.
And when I say long period, like going back to that Roman centurion example I said, it held power for 2,500 years.
But I don't think that's inflation. That's debasement. That's protection against debasement.
But the dominant reason most people say why you should buy gold is inflation hedge.
So I think people are actually confusing currency debasement for inflation.
I don't know. But I think there is genuinely people think that whenever there is an inflationary shock, like the 1970s, gold does well.
Yeah.
It can, but it can't also.
If the inflation shock is responded to central banks by raising interest rates, then gold is going down. So it's actually a bad.
Even there's a. I think you have to qualify that. So there is some evidence to show that if there is a positive inflation shock, gold might be responding not to the rise in inflation, but to that unexpected shock of inflation going up.
So and interest rates.
Yeah, it tends to rise in that period. Ironically, it tends to fall after.
Yeah.
So COVID happened, gold rose for a bit, then it fell for a bit. 2008, that was supposed to be the end of the modern capitalism as we know it. Gold did nothing for the next decade.
Yeah.
So there is a whole lot of qualifications when people say this. So
you're saying it's not even like a safe haven asset?
Safe haven asset, yes. So I ran the numbers, pretty much excluding one crisis, I forget which one, during every shock, the Gulf War, dot-com crash, 2008, COVID, that 2015 Chinese yuan depreciation.
So anything bad happens?
Gold always does well. It always outperforms equities.
Okay. So
during that crisis period.
So again, wearing the hat, you can see it. Maybe people knew that there's an Iran war coming. That's why the gold went up. And if it is solved, it will come down.
Astrology is not a good look for a person who runs the largest options trading platform in this country.
Bro, that's not my point. See, I'll tell you something. Military movements and positionings are not things ki, Trump woke up one day and say ki, hey, bhai, tu Qatar mein hai, kya chal ek missile chhod de. You have to mobilize armies, you have to mobilize, you have to prepare the warheads, you have to do so. Like it's a 2-3 month preparation thing, right? You can't chumma wake up one morning. And, so it's a very logistically complex exercise.
Yes.
If there's plans like that, or even if something is brewing, all these hedge funds, everyone would sniff it out. Maybe the rumor is what propelled the gold to 4,500 to troy ounce. And immediately after Iran strike, did you notice it fell from 5,500 to 4,500? It's almost like buy the rumor, sell the news. It's crazy. I know you won't buy it, but in case somebody wants to wear my hat.
The problem with all of this is it's like, forget me debunking, it's just one reason. Whenever people ascribe one reason to an asset price movement, my alarm bells always go ring up.
Okay.
Like,
but it's a pretty huge reason.
I mean,
Iran.
It's like, what is that saying? You can't disprove a negative. So it's like one of those things.
So basically, people should buy gold as currency debasement hedge, especially if you're living in
an emerging market country, anything like, even if it's India or Turkey, Argentina, whatever, you're better off in gold.
Second one, in case
crisis
something
hedge.
goes
Crisis
wrong,
hedge. Always gold, if you run a portfolio optimization curve, you start by 0%, 10, 15, whatever it is, until roughly 20%, it enhances your portfolio returns, it reduces your portfolio drawdown. For me, more than increasing the portfolio returns, I think the gold's ability to contain drawdowns is the most, is the quality I like, because regret minimization.
It's a very nice shock absorber.
Yes. It's also math, right? If your portfolio falls less, your recovery times is lower.
Yeah.
So the biggest reason why investors don't stick around with these things is because the drawdowns tend to be...
And no panic. It's much more emotionally easy to manage.
Yes. And these are better reasons than saying gold is inflation. No, it doesn't. You need 10 years for gold as an inflation hedge story to play out. Even then, it's very, very volatile. But currency debasement, you can run the numbers yourself. Hold gold constant. Run the average depreciation on rupee, roughly 3 to 4%. You're making 3 to 4% yield on an asset which doesn't yield anything in a country like India, where rupee structurally, as long as we are an importing country, has to depreciate. Set aside the caveats.
Yeah.
So that's a much better reason.
Like we said last episode.
Exactly. And the second reason is, going back to your tinfoil wearing hat, if the world is going to hell, you want to buy dollars.
I feel bad even saying this, but a lot of Jews during the Third Reich were able to escape because they could give physical gold to the Nazis who were at checkpoints, bribe them. To bribe people,
It's a universally accepted medium of exchange.
Yeah. If there is blood on the streets tomorrow, if there is chaos tomorrow, if the societal order collapses, you can't say ki
it's the last port of call.
Yeah, you can't say ki boss, mere paas ETF hai. You have to go physical gold too.
You can't not talk about gold without extending the line of thought to the eventual apocalypse because gold is hedge against apocalypse.
Gold is hedge against apocalypse.
So, which also naturally there's a lot of debate often when people say physical gold is the best gold. All things held constant, granted, yes. If you don't trust your government, if you have the risk of confiscation, and we've already seen in 1900s, physical gold is the best way to buy gold. Agreed. But the thing is, do you really want to be that pessimistic is the question.
No, but you can always prepare for the worst case.
So which means, by that logic, you should not invest in equities. You should have no other financial assets. You should be 100% in equity. The only thing you should own are guns, ammo, and beans. That's it. And a remote forest, preferably north of Bombanalli. But, at least even though people assume that I'm pessimistic, I don't think the impending collapse of civilization as we know is nigh. You can still afford to trust your government. I do. That's because I'm in India. If I was in Turkey or Argentina, I wouldn't be saying the same words. So this is also very context dependent, which means in the hierarchy of options of gold that you can buy. So physical gold, you described all the duties, the taxes, etc. On top of that, there is storage risk. Do you trust your neighbor or relative or people inside your house?
Even if you put it in a bank locker, they only give you 10% protection.
1 rupee.
What?
Yeah, I think the value of all your assets held in a bank deposit is 1 rupee or something.
They give you 10%. 10% insurance, yeah. I think 10%, not 100%.
Okay.
If you put 10 kilogram gold in a bank locker, if you have that kind of money.
Yes. Yeah. But if you're a Mallu, so yes.
Oh my God, this Mallu thing won't end. So
you still haven't told me how, but let's go on.
I think we should talk about, now that we say that it's not a bad idea as a shock absorber and a portfolio drawdown minimizer, we need gold. Maybe we should talk about which are the ways to...
Yeah, so hierarchy. First is the physical gold. Yeah. Personally, I don't want to own physical gold.
Jewelry, bars and coins.
In India, jewelry is not an option. You have jewelry regardless of whether you own it or not.
So 3% you have to give GST if you are looking at jewelry.
Yes.
Making charges of 8 to 25%. Some of these jewelries take 25%, dude, I don't know what. The better the brand, the more the making charges. 5% GST on making charges. Liquidity is like... because you have to look at liquidity when you look at gold, right? You can sell it, but the jeweler will again deduct the making charges, etc. Melting loss, they'll say, etc. They won't melt it, they'll sell it to the next person. But the point is, so here's the big takeaway. 10 to 20% loss the moment you buy jewelry.
Straight away you're done, yes.
Because of GST, making charges, etc.
Yeah.
And so ideally stay away unless your wife needs it. Or your husband, because in case your husband is Bappi Lahiri or something.
I don't think any Indian is staying away from gold. So it's, but the math holds up. So,
right. Yeah. Maybe we can evaluate coins and bars next. Coins and bars is interesting because it's only the GST on paper. But the problem is there is a premium for what they called assaying and minting charge. And most places, and this is really important. Yeah. If you're seeing gold bars being sold on any platform, mostly e-commerce platforms and all, the premium on gold price is huge. So I was looking at it. So liquidity is high for gold bars, agreed, which is a good thing. But the problem is the amount they charge if you're buying it from any of the e-commerce platforms, etc., it's really high over and above gold. Because
roughly how much are we talking about?
So I actually did the numbers. So I'll actually talk about it. So one is, if you're looking at e-commerce platforms, the number which I found on an average is roughly 10% above the actual spot rate. But the lower amounts, 1 gram, 2 gram coins, have much higher margin, this 5 to 10%, than big amounts. So if you're buying like a 10 gram or a 50 gram, then it's not so bad, but it's still bad.
10% is a lot.
It's a lot, right? And then there is GST again, 13%, 15%. Right? You have to avoid 1 gram purchases because the margin on those is very, very high, right? And there is one thing, a lot of people say there's a discount on gold, etc., especially the online platforms. You have to learn something. There is no such thing called discount on a commodities. Commodities never go on discount. If there's a discount, there's some hidden scam which we don't know yet. Right? So the best ways to do gold is local wholesale hubs, bullion trading portals, buy big quantity. Local jewelers best to be avoided.
Buy big quantity. You're talking about gold.
I mean 10 grams, 20 grams, whatever, right? And always avoid local jewelers because there are so many scams. We have to do a new episode on gold scams in India. And one very, very important rule. This is one rule I have always. A lot of people ask, how about buying gold from trusted entities called banks, right? See, never buy anything from banks. Like, it doesn't matter what. If you're buying insurance, don't buy from bank. If you're buying mutual funds, don't buy from gold.
Universal rule. Banks are for banking, nothing else.
Banks are for banking, do nothing else from banks. My God, it's so crazy how much of a scam banking is. Please don't buy. Like, if you're watching this episode, please don't buy gold.
No matter what kind of puppy face the RM is, it's okay.
Right? Don't buy gold from banks. Always buy from, if you're buying physical bullion, buy from a trusted portal or a local person, and always compare the real market value of gold, whatever carat it is which you're buying, 24, 22, and then see.
You need to buy with that mark, whatever it is.
Which one?
What is that? BIS hallmark.
BIS hallmark, right. But there is a scam there. People, so there's like a 10 gram bar, and then there's a third.
Next time we'll do like a shot whenever you say the word scam.
People do this, dude. Like
the longest gap between you not using the word scam is like 3 sentences.
So I'm going to ask you point blank.
No, there.
Name one field in India where there is no scam. One field.
Zerodha stockbroking.
Very nicely played.
Mutual funds. I know you will disagree. We'll get to that later. I was hoping to trigger you.
So the third one, e-gold. I think maybe.
No. This is again another one of those terrible options. See, even if you buy physical gold from Amazon or whatever it is, you're ultimately getting gold. Like you might have paid 15% premium. It's fine. But with digital gold, my problem is it's unregulated. We have no regulator.
Oh, so you're saying there's absolutely no recourse if something. So all these entities are working under who? SEBI?
No,
FMC,
there's no SEBI. Gold is an unregulated commodity in India.
So, okay. So you're saying none of the e-gold platforms are regulated, and if your money goes,
who's gold's regulator in India?
I would have assumed, no, not SEBI.
SEBI regulates financial contracts on gold.
We don't have FMC, Forward Markets Commission.
There's no regulator for gold. It's unregulated.
So it's just like
it's there.
You buy a car, you have consumer court.
That's it.
Maximum you have.
I mean, consumer, what will you do? Like you'll see your case number on the website, assuming that the website works, but there's nothing else.
Okay.
So the first risk is, of course, you're buying from an unregulated. The company is regulated by MCA.
Yeah.
That's it. Then
so that's like every company in the world. Yeah.
That's it. Yeah. So you buy gold from that. They say that it will be held by a vaulting agent.
Yeah.
Do you really want to take that risk? So just so that people know that the way it works is, if you buy digital gold, whatever it is, you buy it on a platform, 10 rupees, 100 rupees, you can buy from. It's a good thing, assuming that it was regulated, but it's not. But anyways, so you buy gold. Notionally, the company assigns you saying that, okay, you own this X% gold. Of course, like a lot of these companies now allow you to get physical gold. The margins again are all the same numbers that you said so far apply. The same math you also said applies here. As soon as you buy digital gold, you're already down by 3% GST.
Not just that.
Plus, there are spreads.
Yeah.
So the gap between the price at which, and like you said, smaller the unit of gold, the higher the markups. The similar logic applies with digital gold loans.
So for the benefit of viewers, can you explain spreads part? Because I don't think, because
the gap between what the company buys it and what it's selling it to, that's a spread.
So basically, if I want to buy it is at 1100 rupees, if I want to sell it is at 1000 rupees, so 100 rupees they make margin on between buy and sell.
So as soon as you buy e-gold, digital gold, whatever you want to call it, you're roughly down anywhere between 6 to 7%.
So e-gold also, no.
Makes no sense. Second thing is, do you really want to take that unregulated risk with something because if you're investing in gold, it's not like you'll invest 100 rupees. If you're making a portfolio allocation decision, it's a substantial part of your portfolio. Do you want to write that? No. Is it the final option?
No, there is gold ETF.
That's the final option. No.
There's SGB and gold ETF. That's it. I don't think there's anything other than
SGBs are dead. So SGB is out of the question. So ETF is the only option. So ETF just so that people understand, you go to an asset management company which is regulated by SEBI. They launch a gold ETF scheme. Whenever people who buy the ETF give the asset management company money, they go buy the physical gold. There is a regulated custodian who holds the gold physically.
In India?
Yes. So, and the advantage with gold ETF units is you can buy it with...
so it's basically like mutual fund, but traded on the exchange.
Yes.
You can buy and sell using your trading platform.
I think gold base was roughly at, some 30 rupees or something like that.
And it almost exactly mirrors the price of gold, except in very violent...
More or less, yes, minus the expense ratio, because on gold ETFs, you typically pay anywhere between 25 to, let's say, 60, 70 bips of expense ratio.
That is 0.25%.
Yes.
0.5% safely, we can assume.
For something which is regulated and safe, that's a price worth paying.
That's not high at all, because any mutual fund...
Like, compared to the other terrible options that we've discussed, it's...
And no spread, and no GST, important part. There's no GST on it.
There is backdoor GST, but because when you buy the gold, your physical gold is in the vault. So the AMC anyways pays the GST there. But there's an adjustment in the NAV. You're directly not paying gold.
I'm not paying GST, right?
You're not paying GST. Yeah.
So their headache.
Yes. So this is, to my mind, this is the way I invest. I have exposure to gold. This is the safest option. There's one derivative on top of this. SEBI regulations say that you can't have a gold mutual fund directly. As in, when I say gold mutual fund, like Nifty 50 index fund, mutual fund, you can't have a mutual fund which holds gold. So what AMCs do is they launch a fund of fund. So there is a fund of fund which is an empty wrapper. That empty wrapper goes in by gold ETFs.
Oh, okay.
So here the advantage is that in case of mutual funds, there's no whole units. So in an ETF, the purchase multiple is...
But it's very small, right? 200 or something.
Whatever it is. So, but it's still you have to do multiples of the last traded price. But in mutual funds, you can do any amount. That's advantage. The only disadvantage is there's an additional expense ratio for the fund of fund. So because the fund of fund is an empty wrapper, there is an expense associated with running it.
And also you can't do, like, intraday you can't get out. You can only get out.
You shouldn't be fucking trading intraday gold in the first place, but but yes, you can't trade mutual funds intraday. Not that you...
But you can't get out anytime you want. You get out at EOD price.
Yes, which is fine.
Which is okay. But the expense ratio higher is... So
barely by 10 basis points, which is not much.
So to summarize, best thing gold ETF.
Yes.
Second best thing maybe gold mutual fund. But ETF, any given day.
Yes.
Stay away from e-gold.
Physical gold is the other
Physical gold,
option.
if you are investing, do coins or bars.
Yes. And all the other factors which you mentioned. Trusted buyer, be aware of the premiums, making charges should be low, everything.
So I have a question, right? So gold right now, I'm on screen, I'm seeing is $4,500, right? Would you, to keep your money safe, would you put your money at $4,500 per troy ounce in gold?
I think it's a wrong question, and I'll tell you why. Like the biggest mistake that retail investors make when thinking about portfolios is they think about the line items. I think that is utterly irrelevant. See, like we've discussed the investment case for gold. We've enumerated the reasons saying that we are in the rupee discussion, you pointed out, we'll always import inflation. We are structurally a higher inflation country, which means, and we are also a net importer, which means currency depreciation is more or less it's a given. If that's the fact, you're earning that premium, that's the first reason to invest in gold. Second reason, it has the longest track record. It has proven its mettle during times of crisis. It has almost negative correlation to equities. It has insane amount of portfolio diversification benefits. That math has proven. So we have established the fact that this is a perfectly viable candidate as a diversifier in a portfolio. If that is the case, the price of gold is utterly irrelevant to you. It's like saying, I'll only buy equities until Nifty is at 25,000, then I won't buy anything after. It makes no sense. It's the exact same thing. So gold is at 15,000 rupees, Nifty is at 25,000. It makes sense. Okay, Nifty is at 30,000, gold is at 20,000.
No, that's not my point. My point is, if you look at gold recently, it has jumped like, one second, I'll just pull out the number.
No, it doesn't matter. I'm saying swap gold with equities. You can make the same argument.
2025 to now, it has jumped 2x. 2025 beginning to now, gold in INR terms is up 2 times.
After 2008 crisis, equities went up 100%.
Yeah.
You can make the same argument. You replace any asset class, there are always...
But okay, I'll add one more nuance to it.
Okay, before that.
3x from 2023.
From 2021 to 25, equities also went up more than 3-4x.
Okay, so you don't care.
No, like I'm saying, you shouldn't care. The price of your stock, the price of your... I'm not going to get into stocks. The price of your mutual fund NAV, the price of gold, or the price of equities, whatever it is, you're looking at portfolio as a whole. Don't look at individual line items. Like, because then you're getting to market timing. If you're good at it, do it. Go with God. I mean, you'll get some wrong body part handed to you. Go with God. May God bless you.
Oh God.
But you can't do scientifically stupid things such as this by saying that just because gold has gone up 3x, who cares? Do you know that it won't go up 6x from here? Like, for example, I'll give you a simple thought. Central banks are buying gold. De-dollarization is happening. Everybody is buying gold. For the first time in recorded history of modern financial statistics, gold is now the second largest reserve asset on central bank balance sheets. In the last...
What's the first?
Dollar. In the last 3 years, central banks have been net buyers of gold. And for the first time, they have been buying 1,000 metric tons that we know of. There's a lot of chatter about China buying gold through other shadow entities, etc. Without that, officially disclosed terms, 1,000 tons every year for 3 consecutive years. For comparison, in 2008, if you went, they were buying some roughly 10 or 20 tons. I gave you, and Indian ETFs have been sending record inflows into gold. North American funds, which are the largest buyers of gold, all flows have been positive. I can't point to one single area where there is gold selling. Now, if this is the fact, like any sane person will say, I'll buy gold. Because you don't have a sell order at all anywhere in sight.
But just to temper it, he's not asking you to buy gold.
No,
he's
I'm
just saying that he won't actively go out and not buy gold,
yeah.
right?
So, my way of thinking is, look, start from first principles. I mean, it's a douchey term to say, but anyways. I mean, start from the basics. Gold is a good portfolio diversifier. The numbers speak for themselves. Think of it as a portfolio component. The price of gold is utterly irrelevant. 2 reasons. 2012 to roughly 2019, gold went sideways. By that logic, you shouldn't have gold. 2021 to 2020-25, mid-caps were roughly, I think for 3 or 4 consecutive years, mid-caps and small caps were up 100% a year. By that logic, you should have 100% of your money in only mid-caps and small caps. But those are all, that's a very dumb way to think about all of these allocations. You said buying from banks is a good idea. I mean, I haven't...
Bad idea.
Sorry, bad idea. I haven't been in a bank so long, I'd forgotten that they sell gold.
Yeah.
Why is it a bad idea?
So the first reason is what is called trust premium. The more trusted a brand, the higher it is. So ironically, apparently banks are very trusted entities in India. I never felt so, but every time... but anyway.
You can grind your personal axe elsewhere. But, yeah.
But when something comes from a trusted name, they can... So banks usually have like 10% plus, 5 to 10% on average, 10% plus in some cases for gold coins and all you buy from there.
That's crazy.
The second thing, and this is like crazy, banks are not allowed legally by RBI to buy back the gold they sold to you. Banks cannot buy gold back from you. They can only sell to you.
What the hell?
So the very people who sold you gold cannot buy back. It instantly kills liquidity, which means you have to go to somebody else with that thing. And that somebody will say, oh, you can't sell this. Oh, okay. So you get the meta, right? Basically you are destroying value immediately because of this 10%. And then there is a liquidity problem. So, I mean, doesn't make sense.
So, TLDR, just buy gold ETFs or mutual funds. Just go to sleep. If you don't wake up, I mean, even if you had physical gold, it makes, it doesn't really matter.
But 10 to 15%, 20% max.
Yes. I mean, I'm also a little hesitant on prescribing exact numbers, partly because...
But not like 50% gold or anything, right?
Ironically, it has worked out.
Which has worked out well in the last few years.
Yes. So again, it's. I mean,
but have some gold. Have some gold.
Always be diversified. Don't go YOLO. All the same BS about, we keep saying about long-term investing, this, that, masala, this and all that, same applies. Just spread your bets, go to sleep. There are better things to do in life than worry about whether it's 25% or 26%. Like shit posting on Twitter.
Don't make a second career out of your portfolio.
Exactly. That's it.
Focus on the main career. That's how money is made. And now that we have talked about making money, the second thing which we also have to talk about is keeping money safe. Right? I know it's an absolutely forced one, but this is the transition to the third episode, which is...
We want views. So we are doing all of this only for views.
How to keep money safe.
Yeah, it's a really good topic. We have a lot of stock tips. No, we don't.
But yeah, please do tune in.
Until the next episode, bye-bye.